Hey guys, just real quick before we start the podcast, we want to make sure you guys know about the Owner's Manual. It's the Independent Dealer Podcast weekly newsletter.
Yeah, Jeff, a lot of fun. It's something you and I came up with. Weekly, pithy, less than 5 minute video talking to you about things you need to be doing as an owner, things you can do to help train your staff. And I think the easiest way to get that, Jeff, is to go to the website, right? What is the website?
Yep. Go to theindependentdealer.com and then just enter your email in to sign up for the newsletter. It's free. It comes out weekly. And like Lou said, it's great tactical advice. It's actionable items. Whereas the podcast, we talk a lot about ideas and stuff and kind of chit chat. This is actually things that you can put into your dealership and make it better this week. So jump on our website, sign up for the newsletter, and here's the episode.
You are listening to the Independent Dealer Podcast with hosts Luke Godwin and Jeff Watson.
Hello and welcome to the Independent Dealer Podcast, brought to you by Buckeye Dealership Consulting. And Luke, we actually have
a Buckeye
Dealership Consulting with us, Mr.
And
Rob.
we got the mighty leader of Buckeye, Rob Fox. So thank you, Rob, the reinsurance guru, we should call you. How about that?
I don't know if that's the case, but I'll accept it.
And we also have Michael T from MCMC in Texas, one of the largest buy here, pay here's in the country, probably one of the older ones too. So thanks for being with us, Michael T.
You're very welcome. Thanks for having me.
Luke, this means we're going to be talking reinsurance, and everyone knows we are big fans.
Everybody should be a big fan.
Everyone should be a big fan. And we're not going to talk about the A's, the B's, the nuts and bolts and how to get it started. This is going to be reinsurance, kind of an advanced lesson. This is like
301 or 500 level. What do you think?
Yeah, this is kind of the end game. That's what we wanted to talk about. We all talk about funding our reinsurance companies and how it's such a great idea and move the money, blah, 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 blah. But then what? Then what?
And that's, actually I've been kind of dealing with that. Our reinsurance company has been open for I think 11 years now. And it's just, if you manage it right, it starts to build pretty big number in there. And Rob, I know you've seen this over the years. Even if you're only selling 25, 30 cars a month, if you do it for 11 or 12 years, it's a big number. And so the money's sitting there. Now what do we do is the title to this one, right?
Yep. Rob, so tell us, to set up the conversation, Luke's funded his reinsurance. Michael's funded his reinsurance. They've got four options, right? Once they decide to do something with that money, they've got four options. So explain to us what those four options are, and then we'll have Michael T kind of jump in and tell us how he's put those into practical applications in his dealership so that us dealers can see, oh yeah, like there's some options here. Like there's some ideas. There's some things I could be doing. What are our options with that reinsurance money?
Sure. There's really only four, as you said. There's do nothing. Okay, just leave it in the bank account. Maybe an interest bearing, but we all know what that means in today's world. It's just now creeping up to something. You can invest it. The traditional investments, the National Association of Insurance Commissioners puts out an acceptable list of what you can invest in and what you can't. And then you can borrow the money out. The IRS is okay with the owners of the reinsurance company borrowing money out of the reinsurance company. Or lastly, you can dividend. As you start having earned proceeds, you can dividend that money out. It's done at a tax favorable status as a qualified dividend. And for majority of people, it's anywhere from 15 to 23.8% is what you'll pay.
And
those are really your four choices.
And so Rob, let's start with number one. Like, let's say we leave it in forever. Is that possible? Or do you have to start winding it down at some point? Because I've kind of started hearing something about that.
So if you're not writing any more risk, yes, you do have to wind it down. Okay. As it earns out, and if it ever becomes fully earned out and you're not accepting any new risk, it's actually then considered a special investment vehicle, and it's foreign at that. And the tax rates on that are huge. And the U.S. government does not like its citizens having money offshore or in a special investment vehicle that's considered a foreign investment vehicle, even though it's kept in America. So yes, you do at some point, if you're done writing risk, have to close it. If you're continuing to write risk, you can have earned reserves, unearned reserves, just sit there.
So let's say I quit writing risk, as in I sold my last car yesterday, and I'm not going to write any more VSCs or warranties, but I'm still writing CPI until I collect out all my accounts. Does that allow me to leave it in until the CPI risk is gone, or not?
Yes, it allows you to keep that open because then you're still acting as a reinsurance company. And it also, you're allowed to keep it open until that last contract earns out.
Okay.
So like in the new car business, some of our guys are writing 10-year wraps. If you wrote one 10-year wrap the day before you stop selling, you could earn it out over 10 years.
Is there any purpose in just leaving it there? Is that just because I don't know what to do and I'm waiting for tax?
And you know what?
Tax
Yeah,
laws to
everyone's
change.
situation is different, Jeff.
Okay.
You know, and this is where you get involved with the outside accounting firms. You know, we have 3 CPAs on staff, and I know our other competitors have accountants on staff. And that's where you deal together and talk about the right time to start taking it out, either in dividends or, you know, well, dividends is really the only way to take it out at that point because you're done. But so when is the best time tax-wise for you?
Let me ask that of Michael. Michael T., when did you, I mean, you've had it forever, right? I mean, I don't know if you can remember this far back, but at what point did you decide?
I need to put some more color in my hair or something.
Yeah, or none. Just shave it. Was there a trigger where you said, I assume you've exercised one of these 3 options, borrowing it back, investing it, or taking it as a dividend. At what point did you decide one of these was good for you at your dealership?
So we've probably been doing reinsurance companies and products for 15 or 20 years. We've been through several different administrators, several different dealer product reps before we landed with Rob. That was probably 10 years ago or more that we landed with Rob.
17 years ago.
17 years ago.
Wow.
Well, I've had a few birthdays, I guess.
Yeah.
So pretty much it probably took us about 3 years to seed the money that we wanted to seed into it and to kind of get comfortable with it and to start. No, this is not your question, but this was our question in the beginning. We're kind of toe tippers. We tip our toe into the water and see how, is it going to be cold? Is it going to be So we first started with a little 3-month warranty. And how's this really going to work? Is this really this product really works the way they say it works? And then you figure out it does work that way. Now, how much more product can I put together? How many different ways can I get this open? Because it's such a valuable tool in our lives. So it took about 3 years to kind of figure all that out. And once that happened, then we figured out, I particularly take mine out in dividends once a year. I don't dividend out all of it out, or even maybe not what's available, just what I want to dividend out. And I typically do that once a year. And I've been
buy
doing
like a Gulfstream or something, or like a 100-foot yacht or whatever you decide to pick up that year.
I'm sure some can afford a 100-foot yacht. Yeah.
Probably. But that's interesting that you do
did
it
it,
once
Luke.
a year. Yeah, and I took a dividend this year because it'd been sitting there for a while, and it, I just said, I'm not sure we're going to be in a better tax position than we currently are in this country. I think it probably only goes up from here. So I thought it was a good idea. So that's an interesting concept, Michael, of dividending out once a year. I mean, that sounds like a great idea. What led you to that?
Just that's the way I wanted to. I don't use my money to live on. We've changed our philosophy over the years. And when we first started, I said, look, I basically take the minimum salary from the dealership that I can take, and I'll put all the rest that I can afford to put into these tax favorable reinsurance. And then I would take that money out once a year, and I would live on some of it, would invest some of it, things like that. Now I've kind of changed that philosophy. I take a larger salary and I use all this dividend money that I take out for particular investments that I want to do. I typically invest in real estate. I have a brother-in-law that invests solely in stocks. and he uses his for that. So
Well, that's what I did this year. To be honest with the viewers out there, is I had an advantage. I had an opportunity to take advantage of a rather large hedge fund, and I said, it's probably a good time to pull some of that money and get in when the market was down this a couple of months ago, and I think that's a great strategy. Real estate. I know, Jeff, you're a big real estate
That's
guy.
when you put it all in Dogecoin, right, Luke?
No Dogecoin. But that's great. Dividends are awesome. Rob, now that we're talking about investments, you said that you can invest your money
Straight from it.
Yeah. So
so your reinsurance company is allowed to have an investment account. And they're allowed to invest it in the market. And again, the National Association, NAIC, National Association of Insurance Commissioners, they put out, and it needs to be updated because it talks about blue chip and, you can't do arbitrage, but it tells you, hey, listen, you can do A-rated stocks, B-rated stocks, bonds, that type of stuff. So within your reinsurance company, you can have an investment account with your unearned reserves and your earned reserves. Because again, remember the IRS, they like you to do that. Okay.
Yeah.
What they don't like is if you just keep it and it does nothing, because you pay no taxes then. These companies pay taxes on investment income. So they want to see you investing it. They want to see you using the money reasonably to drive revenue that then drives tax, receipts.
But I
There's
assume
certain stocks or certain things that the reinsurance company can put it in.
Again, I mean, again, it's really broad. You just can't do like arbitrage. You cannot do speculative. Just a minute ago, you made a joke about Dogecoin. None of that. Okay.
They don't allow it.
Yeah, you're not going to be doing that, but you can do, some good asset-backed business. You can do, again, what they call A-rated stocks, and B-rated, and also your bonds, your A and B-rated bonds. You just can't do junk bonds. You can't get really risky with it, but you can be very conservative with it.
And that is something that the folks you have on staff, Rob, can advise the dealers on how much they can use and how much they can't use, and the risk that's there, correct?
Correct. Yeah. Traditionally, in most everyone, they want you to keep 20%. In fact, this is part of the NIAC guidelines also. 20% in cash and cash equivalents, and then 80% you can go invest. Okay. Now that doesn't take into consideration loss ratios or anything. I'm being really general with that. But they do want to see you at least 20% in cash and cash equivalents to cover any losses you might have in a particular month.
Because losses do happen. Rob, that might be something to just touch on real quick. I know that might not have been where we're going, but leaving that 20% there, because if you've just started your reinsurance company, that money's got to build. So how long do you see before you can really start taking advantage, of a dealer selling 20 to 40 cars a month?
It depends on the underwriter, the insurance company. Okay. There are some insurance companies, no matter how well it performs, for the first year will not allow you to borrow the money out. Just won't. Okay. There are others that have requirements on your trust account that want you to have 110% of your earned to your unearned. I mean, so it runs the gambit. We like to see in the first year, keeping it really conservative, trying to keep it in the 60% range, borrowing out. We have gone higher depending on the product and depending on the term. And then as we get loss information, our actuaries will do loss curves on our current business, and they'll tell us, hey, listen, you can lend out this much. And we have a good relationship with our insurers, and they'll take our loss curves and allow us to do the inverse of the loss ratio. So if you're running a 20% loss ratio, you can borrow 80. You're running 29, you can borrow 71. And so, but again, we provide that data to the insurance company, and they allow us then to do the documents.
Well, I think that brings us to another one of the top four things the four things you can do. And that would be lending the money to yourself or to your, to reinvest in your company or whatever. Can you walk us through how that works, Rob, and the advantages there?
Well, sure. You're borrowing from yourself. I mean, in the buyer payer space, we all know these things eat cash like cows. I mean, they just graze on it. So if you put a plan together, you can actually pay off your line or pay down your line to make it more manageable. I have one client who was getting ready to retire, had a $40 million line, wanted to get down to 10 because he didn't want to leave the next generation a $40 million line. And we were able to do that with him. You know, what you need to do is you need to make the loan doc, there's things that the IRS wants. You need a board, you need minutes approving that loan. You need a loan document. Okay. You need an amortization schedule. And it has to be performing. Again, go back to what the IRS looks for, investment income. Well, what's the best way to get investment income? A loan, it's a steady stream of interest income.
So, Michael, why did you guys not implement that kind of a strategy? Why wouldn't you have just borrowed the money back to yourself to buy real estate or other things? Was there a reason you took it as a dividend instead of either investing it inside the insurance vehicle itself or borrowing it to yourself?
I think that just to try to keep it as simple as possible for me, it can get pretty complicated. And I have borrowed money to use for investments. It gets pretty complicated. I just try to keep it as simple as possible for me. I pay the taxes. It's a favorable tax rate, and I go make the investment. There's a lot of different ways to do that. I know a lot of what y'all are talking about. I know a lot of dealers that loan the money back to their dealerships, so they're paying themselves the interest. It's a fantastic tool. It's very flexible. There's tons of things you can do with it. If your dealership can afford the extra cash, that's the main thing. Then by all means you should be using. These are smart plays, and they're all completely above board and legal. And there's nothing. I think the term offshore, which people don't use that much anymore, that used to scare people. Oh, I'm going to have money offshore. Really, money's not really offshore ever. So,
hey, Michael, that was interesting. Talking about why you loan and didn't loan. We've loaned a bunch of our money over a time, loaned it back to ourselves to get rid of, not to never have to have a line of credit. And I'm sure with the size of your business, it's when you first start putting that money into the reinsurance company, the cash flow bite that it takes. Can you walk through that and how scary that was? Because I remember doing this thing for 2 or 3 years and then start looking at the cash flow, and I was like, I'm shutting it down because it's eating me out of house and home. And I remember getting on the phone with Dave Keller, and I said, Dave, you got to walk me through, why do I keep this thing open? So he did a little, song and dance and a spreadsheet, and he showed me, and I said, oh, I see why I keep it open. So talk about how scary that is, the initial cash flow threat.
Well, so that it is. If you have to, your business has to be mature enough to handle it, and then you have these expenses. So let's say in the beginning we put a $300 per car 3-month warranty on. So we had to be able to afford to put that 300 times 3,000 a year and move that cash away. But we were already really spending most of that money anyway, because we were fixing the people's cars. We were just doing that out of good policy. We didn't have any warm and fuzzy to give them. When we started the 3-month warranty, hey, the customer got a warm and fuzzy. Something breaks down, they're going to come back and fix it. Now, instead of taking it out of our right pocket, we're taking it out of our left reinsurance pocket and paying those same fees.
And you're
it's
getting
just moving money around. The difference was we moved it out of where the company was going to take that profit and moved it over to where the reinsurance company is now going to take that profit at a much favorable tax rate. That's really the bottom line.
If you look at that $900,000 a year that you just demonstrated, most of us are going to pay almost 40% of that, and so it's a huge cash flow give back once you can recognize that. And that's essentially what Dave Keller was telling me. Rob, I know Michael's probably past the 3-month 3,000, but that's where I started. Is that where most dealers start? And how do you see it evolve after that?
Most dealers actually start now with CPI. Okay. When we go and talk to dealers, we talk about accounting for the transaction you're already doing. Michael just made mention, hey, we were fixing the cars. I'll tell you what, there's 3 dealers on this call. If I'm a good client, you're fixing my car, whether it's covered or not, because you want me to continue to make payments. That is our basic covenant, right? Is that if it's running, I'm paying. So we go in and talk to people. Let's account for the transaction. Well, the first transaction I can talk about is how many people aren't insured that need to be insured? Well, 60% of your portfolio, more than likely. And by the way, why? Well, they can't afford it. Well, what if we gave them a cheaper option and you could do CPI? So we're seeing more people start with CPI, then the 3-month warranty, then GAP, and then go into a service contract. And that seems to be the normal progression. But again, it's accounting for the transaction.
Yeah, I think the last product I went to was CPI, so that's funny.
Yeah, the CPI for me is hard to wrap my brain around, but it does make a lot of sense because again, CPI is such an easy sell because that's money that technically would have been going elsewhere to some Geico or Progressive, and instead you're capturing that insurance money as a CPI. The warranty thing makes sense because I was already giving a 3-month, 3,000 mile, guarantee on my cars. So it's like, okay, yeah, like Mike said, just officially account for it. Put that money aside in a reserve instead of self-reserving for it.
So there's two big differences here. The warranty money, the dealership is funding. You're funding it out of your cash flow. The CPI money, the customer's funding it. It's a customer pool that's taking care of customer accidents and wrecks and fixes. So we're not supplying that money to the CPI, the customer basis. Yeah. It's a huge difference.
That's a great point, Michael. I didn't even think about that.
One of the big pushbacks we got when we started doing CPI was, I've already maxed my client out. They can't afford to give me that extra $90 a month. I mean, I heard that everywhere. And I'm like, you don't understand. They won't give it to you. You didn't max them out. We kept it at $20 a week, and by God, it works.
Hey, everybody, real quick. All this great reinsurance talk about big trust accounts and earned premiums, and someday we'll get there. But if you do have a couple extra bucks, make sure you're buying your GPSs.
Just as simple as reinsurance helps protect you, pastime GPSs help protect their assets, which is you as well. So they kind of go hand in hand. If you really want to protect your business and protect your asset, which is your portfolio, or if you're not even a buy here, pay here store, you're a retail facility, protecting your assets is what Pastime does. And luckily, they're the best in the business, and you need to go see them. It
makes a huge difference too, Luke. I think sometimes when I'm looking at a customer that might have expired insurance, and I'm like, okay, do I go through the hassle of putting force place CPI on them, and then this? If I GPS them and I see that they're somewhere they're not supposed to be, or that I don't expect, or I can sometimes use that as a decision of whether, like, okay, yeah, let's do CPI and let's give them some time, or no, we just need to go repo this thing. I'm not even going to go through the hassle of force placing the insurance. I'm just going to go pick the car up.
It's a great collection tool, Jeff, and I don't know what we'd do without them.
Yeah. All right, back to the episode.
It's a great product.
Back to the fourth one, taking it out as a dividend from my reinsurance company. Is that not just a wash? I mean, I brought the money from my dealership over to my reinsurance company so that I wouldn't have money in there to take as a dividend. If I just take it back out of my reinsurance company as a dividend, aren't I essentially just kind of paying the same on taxes either way?
It depends on what your tax rate for normal ordinary income is.
Okay. So
totally based on that.
Yeah, currently,
in some ways, it could be a favorable tax rate. And maybe if you're not in that tax bracket, it may be a wash. But there's other things that are the benefit. The customer feels better when they leave the dealership, even if it is a wash. The customer, even if you spent all of your money, the customers benefit. The customers keep their cars running. These products help keep their cars running. They make payments, and you're making money on that side, on the business side of it, on the traditional, original buy here, pay here side of it.
I mean, I think, Rob, correct me if I'm wrong, but currently, depending on your tax bracket, but 20% long-term capital gains, 3.5% Obama tax, and then your state tax. And Texas is lucky they don't have state income taxes, and Florida's lucky. So Texas is very advantageous at, let's say, 23.5%. South Carolina, not so much, 31.5%, but still it's cheaper than 37%. That 37% plus 8%, so 44% that I would be paying. Does that sound about right?
Yeah, and Jeff, what you can also do is you can time it. So one of the biggest things that we're not talking about is the deferral. Okay, so you can time it to where you have a loss and take the dividend, and it really is not a taxable event.
Yeah.
In your case, with your concern, what I would do is I would open a second account to where your earned premium under your reinsurance company, where your earned premium can sit. You can do whatever you want with it there. You can invest it. I told you NAIC puts rules on unearned. It does not put rules on the earned. So you open an investment account by ABC Reinsurance Company. Invest it, treat it the way you want to treat it, like you would if it was yours. Don't dividend it out. Loan it to yourself, whatever you want to do, but keep it underneath that company until such time your taxable situation is, hey, I can take some of that out and not have, and not that big of a tax bill. And that's the biggest things these offer is tax deferral.
Borrow some back, buy some real estate, do a cost seg, take an advanced depreciation, and then take the dividend that same year because when you say wait for that year when your income is down or when you have some large loss to offset it, then bring that dividend back in. That makes sense.
Yeah, and some of our people are using their money from their reinsurance companies to get into these opportunity zones, and that opens up a whole new way of not having a taxable event. And we work with the outside CPA firms to help them do that. But we had quite a few dealers open new lots in the opportunity zones to take advantage of those.
So you're bringing your reinsurance money back in, either borrowing it or dividending it, but you're putting it in an opportunity zone that will never pay
capital gains.
Yeah, that's so smart. So did that works when you're the only owner of the reinsurance company, right? I mean, I guess I could see Michael T's situation. If he has multiple owners, like you mentioned, a family member that might have a different objective. So he says, hey, my objective is to buy real estate. His objective is to buy stocks, and I don't really like those ones. So let's take the dividend. You do what you need to do. I do what I need to do.
Traditionally, we set up two different reinsurance companies. If you have two different people, okay, even brothers and brother-in-laws, it's
our dads.
Yeah, or your dads. Okay, dad's a really good example.
Oh, buddy.
Different needs. Okay, you might be thinking of private school or a pool in your backyard, and you say, I want a dividend. I want to put my kid in private school. I want to put a pool in the backyard. And your dad's sitting there, and he's my age or older. And he says, hell no, I already put you in private school.
I'm not taking money out.
I'm not taking a dividend. So you need to agree on it. So what we do is usually when we have two or more members, we allow each one to set up one.
I would recommend that.
We've always had separate reinsurance companies.
I didn't want to speak for you, Michael, but yeah, they have all separate ones.
We've always had separate. And for that reason right there, because we all want to do something different with our money and don't necessarily want to have a partner in there.
How does that work logistically then? If you have two reinsurance companies at your dealership,
so 1-to-1,
they're just funded left one, right
every
one.
dollar comes in, 50 cents goes to one, 50 cents goes to the other.
You guys do it all.
Yeah, you just take it down to $1. Okay, you could have 6 reinsurance companies. I'll split that dollar evenly 6 ways.
We can speak to ours. We can speak to ours. We have, let's see, we have 1, 2, 3. We have 6 reinsurance companies.
Wow.
Because I have one and my brother-in-law has one. And then I've got 3 set up for my children. And he has 1 set up for his children.
Yeah.
So
that's great.
And all that money that cascades just gets split into however we decide to seed those. And then Rob's guys take care of that. We say, look, 40% goes here and 40% goes there, and 20 there and 20 there. And that's
Man, I wish I would have. When I set mine up, Rob, I wish I'd have talked to you about it, because I can tell you what can happen, because this happened to me a couple of years ago. We were looking at setting up an investment account with our money, because if people don't know, most of these accounts, all these accounts are sitting in trust accounts, and these trust accounts pay like 0.2% interest or whatever. I mean, it's nothing. And when this money gets very large sitting there, you need to do something with it, because it's time value of money. Inflation, which we've just gone through, can really crush that value. And I had 3 investment companies come in and pitch me and my dad and our wives. And in the end, we did nothing, because my dad and my stepmother's, lack of investment savvy, or lack of risk, because they're older in life too. So I don't necessarily blame them all that much.
Different needs, different wants.
Mm-hmm.
So, but if I had a separate one, I could have used my money however I felt like it, and I wouldn't even talk to them about it. So anyway, it's a great idea.
And when we suggest that, we walk into it. I mean, you can come up with a million different scenarios that you just described, okay? And it's just easier to separate them up. They're not that expensive. When we set up more than one, we cut prices on them. So to set them up, it's not that expensive.
Makes sense. I mean, imagine, from the logistics standpoint, tax returns, all those types of things, you pay a little bit more, but from a long term, let me ask you this then. What if the dealership has multiple owners, but only one of them wants the reinsurance company? Have you seen that, where maybe the dealership has like a father-son or father-brother?
It has to be whoever controls it, okay? So you could have 4 owners, and each one 25%. If they don't agree, then we don't set up, because you can't do that, because you're taking risk.
Mm-hmm.
Okay.
So I can't go out and say, I own a car lot with my dad, and I'm going to set up a reinsurance company that mine and my dad's car lot is going to fund my personally owned reinsurance company. We
would want your father to sign off on that. If it's 50-50, because what I don't want to walk in, I'm going to use Michael, walk in and you meet Mark Jones. Well, if I time it right during a year, Michael might be gone. You know what I mean? He might be off on vacation. And for a month, I only see Mark Jones. Mm-hmm. And he says, oh, yeah, I own this place. Don't worry. Here, I'll sign up. Well, then all of a sudden, by the time you're done, you're funneling all this money to Mark. He's not even an owner. So when we go in, we try to find out who the owners are. And then they have to decide as a group. And if they want to make sure that Jeff gets all the money, we're good with it. But they're going to tell us it's okay.
Yep.
Yeah, that's a great idea.
Mm-hmm. Yeah, smart to have your own. I do know, I say that because I've talked to a dealer that I think is running something similar to that, and I don't know what company they're running it through, but obviously you got to make sure everyone's signed up and signed off. And so my last question is there a dollar amount that you would say, like, if I have earned premiums, should I be putting those somewhere? Like, is it 20 grand? Is it 200 grand? Is it 2 million? Like,
so any earned premium, I would move out of any trust account with an insurer. Okay. I'd still keep it under the company. So for tax reasons, I would keep it under the umbrella of the reinsurance company, but I would move it away from where the insurance company can tag it if your other products go negative. So once it's all in the trust account, the insurance company's allowed to touch it. So like with our clients, some of their money's in trust, some of their money's not in trust, because we move the earned premium and we will move it monthly. So it's not subject if we all of a sudden have the Chrysler minivan transmissions again. Okay, where all of a sudden everyone went negative, they can't touch your earned premium because you moved to somewhere they can't get it. So any earned premium, first off, should be moved. Second, you should invest it. Minimum, somewhere getting you some interest.
Yep.
A lot of these people that put money, they force you into their bank accounts, their trust accounts. If you look at it, you're getting 0.01% interest and $1,000 in fees every year. Well, the fees are bigger than what you're making in interest, so it goes negative. You need to manage that so that does not happen. these are great profit centers, okay? And these are outside of your dealership. You still need to manage them. You can't just trust. So you need to look and say, okay, I want to move that money. Go to your local bank, open up an account under ABC Reinsurance Company, say, I want you to invest this money. Even that's better than doing nothing.
This is something that everybody should listen to, because I made the mistake of having all this earned out money for years and years and years that I should have put to work. I can't tell you how far behind we got because we didn't make this money earn. So Jeff,
and why didn't you, Luke? Is it because you didn't know, or because your reinsurance company didn't come to you and say you need to do something with this?
Number one, I didn't know. And then I finally found out, I think in about 2018 or 19, then of course COVID hit. So I was kind of stockpiling cash just in case we needed to. But I mean, honestly, it's the lack of education. I did not know. And I know now, and I'm hoping everybody out there is listening to this and thinking about it, because it is definitely something, especially with inflation that we've had. If you just left that money there, you're good. I mean, it's worth less than it was, this time last year.
Especially right now, okay? We're seeing a lot of our dealers put their money back into their bank account, but they're getting interest now. I mean, they're getting interest, but they're getting 1 or 2% because they've got such a good relationship with the bank. Now the bank is giving them a little more. And again, that's better than the scenario I just told you, where you're getting 0.02 and $1,000 in fees. You can't, these things will not, they'll still be successful, but they won't be as successful. You need to manage them.
Yeah, and Jeff, I think another reason I did not do that was because I didn't know if we would need the cash if we started to grow really fast, and I needed that cash back. I was afraid if I took distributions and I went to my dad for a capital call, he'd be like, yeah, I just don't want to do it anymore. So I kept enough there just in case we went on a run. And I think that's another reason, because then you can borrow it back out and pay yourself interest. I think that's a reason to keep some of it there.
Okay, Rob, so I do have one more question. If you're running a reinsurance company currently elsewhere, is transitioning to a Buckeye reinsurance company, do you bring everything over, or do you just wind down the one and start the other one?
You just bring it over.
Everything's transferable.
Yeah,
swim out to Turks and Caicos, bust into the bank, grab the cash, swim it back.
Well, Michael, and it sounded like, Michael T, y'all went through that, right? You went through a transition to Rob. I mean, was that a difficult situation, or was it pretty simple?
Pretty simple. Pretty simple. Now we didn't. I don't remember transferring it. Maybe we did. This has been obviously 17 years ago, and we would have been much smaller then too, and maybe only had 1 or 2 reinsurance companies at that point with a much smaller load. But we probably just ran those down and just started with, you can shut one off and start one tomorrow. So they're fairly easy to deal with, very flexible.
But there's even a change of management letter. That's all you do is fill out a change of management letter, because you own these reinsurance companies. That's one thing, you guys have to remember, you own them. Okay. They're your assets.
So I'm not setting up a whole new reinsurance company. Like when you say change of management, like I'm literally keeping the same company, the same name, the same everything. It's just a new administrator, a new
underwriter, new administrator. Okay.
Mm-hmm. And all my current policies, the paperwork stays the same. They're still administered. I'm not going to two.
Yeah. So they would still be administered, and that trust account will still stay with that company until it earns out.
Mm-hmm.
Okay. So yes, but it's just another asset. Again, it's another asset under the veil of the company, under the umbrella of the company. Just you account for it. We've got 10 accountants that work at Buckeye, and 3 of them are CPAs. And that's all we do all day long, is financials.
Oh, well, there's a lot of information here, Jeff. I think it's probably time to wrap this thing up.
Yes, thank you. And everyone knows how to get a hold of Buckeye if they need to.
Please.
And nobody knows how to get a hold of Michael T if they need
Yeah,
to.
don't.
And that's the way he
Call Mark. Call
Nobody
Mark
knows.
Jones if you have
Yeah,
to.
call Mark Jones. He's got all the answers. He's the guy.
All right. Thanks, guys. See ya.
Thank y'all for
All right,
doing
thanks.
Dealers helping dealers. Please leave us a review and subscribe. The Independent Dealer Podcast.